there are a couple of handouts on your table as well. So you'll see that there is a best interest checklist. And then there's also another sheet of paper, sort of just under your agendas. It's got 3 different cases on it. They're the 3 cases that have just recently gone through the industry and are relevant to financial advice or financial planning. I will be here all day until I think this finishes around 1:30. So I'll be around all day if you have any questions or you want to talk to me about anything. And I just want to let you know that, yes, this is about FoFA and some legislative changes, but it is still really changing. So we can sort of tell you what's happening now, but keep in mind some of this will change in the next couple of weeks or the next couple of months. Okay, let's get started. So today we're going to focus on best interest. So you all know this. We talked about it last year when it came into effect, but this is going to be a bit of a refresher, and it's going to give you a little bit more information as well. Best interest replaces the know your client and know your product rules, and it is now mandatory. You should all be doing this now. The idea is to leave the client in a better position than what they were before, and the onus is now on the advisors themselves. So we're still ultimately responsible for you, but it's yourselves as the advisor that's taken on quite a lot of that responsibility. Best interest. So these 4 points are what I'll be talking about a little bit later on. So this is just a little bit of an overview. I'll also be talking about what's known as the safe harbor provisions. So for best interest, I'll be talking about acting in the best interest of the client, providing appropriate advice, warning the client if they don't tell you everything, and to prioritize the client's interests. Safe harbor provisions. So these, well, there were 7, but now it's sort of 6. These are 6 steps that are actually in the legislation themselves and in the regulatory guides themselves. And it's a bit of a checklist, and that's where your checklist comes into effect. The checklist is 3 pages, but it's really that front page that's important. The other stuff is sort of supporting information and examples. So I'll just be going through that as well. Number 1, identify the objectives, financial situation, and needs of the client. The idea behind this is to look at the primary goals and objectives section of the SOA. Really drill down, talk to the client, ask them why it is that they've come to see you. Okay? That's okay with that. Use your fact-find documents. If you're not using one of our fact finds, please have file notes. We say this all the time, but it is so important. Number 2 is identifying the subject matter. This is the scope of advice. We're seeing a lot of clients, a lot of advisors not completing the scope of advice. It's really important to talk to the client, drill down why they've come to see you, put that in your SOA, and put that in the scope of advice as well. You don't necessarily have to be an expert in everything. If you're a risk advisor, that's great. Focus on that. You might be authorized for risk, super, managed investments, even SMSF. But if you don't do those things, that's okay. It's okay to say to the client, Mr. Client, I'm authorized for quite a lot of things, but my area of specialty is risk advice. It's perfectly okay. So here's an example of a risk-only SOA, scope of advice. We're noticing a lot of advisors are not completing this properly at all. It's important to underline what it is that you're giving advice on in this side of the sort of slide. Advisors, please, it's not that difficult. Please start doing this. If you decide you don't want to underline, you want to bold, that's okay, but please amend the wording on top. Please do not add or delete things on this. We're seeing a lot of advisors adding things, deleting things, moving things around. Please just leave it the way it is. We've tried to make the SOA as simple as possible for you guys, and this is one of those things. Here's an example of the investment scope of advice. You'll notice sort of in the second paragraph here, it's got must select at least one in brackets. Please delete that. That's an instruction to yourself as an advisor. We're seeing a lot of advisors are leaving that in. So that's sort of showing to us and to the client that you're not really personalizing the SOA, that you're not actually focusing it for that client, you're just going over it really quickly. Here's an example of primary goals and objectives. What we see a lot is in the short term, maybe, this is an investment one, sorry. What we see a lot is in the short term, it might be, Mr. Smith came to see me because he wanted $500,000 worth of life insurance. That's not a primary goal or objective. The reason that the client wants life insurance is to protect their family in the event of their death, to ensure that their family is covered if anything were to happen to them. That's the type of wording we want to see when we look at primary goals and objectives. The idea might be to insure them to $500,000, but why? Why is it that you're recommending that? Why is it that the client needs that? You'll also notice at the bottom part of this slide, there's a bit of a disclaimer. It talks about inaccurate and incomplete information. This requirement has always been there. I'll talk about it a little bit further on, but the idea is if a client came to see you, there's no necessity for them to tell you everything. They may have 10 different investment properties and 20 different children, but there's no obligation for them to actually disclose that to you. They might decide, well, you're only giving me risk advice, I don't see the point of that. Or this is sort of what I want. They might be quite headstrong, and that's perfectly up to them. Okay. Number 3 is if the information is incomplete or inaccurate, you need to make reasonable inquiries to obtain accurate information. So as I said before, drill down on why the client is coming to see you. Use your fact-find documents, use your file notes. If the client doesn't tell you everything, that's okay, but you need to let them know, Mr. Smith, this advice is based on what you have given me. So that's why when you do your SOAs, when you do your file notes, when you do your fact finds, it's important to accurately record what it is that the client has actually told you. So that if anything happens 5 years from now, the client can't come back and say, but I told you that. You know, I'm sure I told you that. You've got your file notes, you've got your fact finds, you've got your SOAs to back up exactly what it is that the client told you. Number 4, assess whether or not you have the required expertise to provide the client advice on the subject matter. As I've said before, you do not have to be all things to everyone. You do not have to be a specialist across everything. If you don't know what you're doing, if SMSF is not your thing, or if superannuation is not your thing, maybe you just do risk advice, maybe you just do investment planning. That's okay, but you need to tell the client that. You might have noticed that they might have 10 different super funds, and you might know just through experience that it's a great idea to consolidate them into one, but maybe superannuation is not what you do. It's okay to bring it up with the client, but don't feel that you need to give advice in an area that you know nothing about. Refer them on to another advisor. Highlight this as a need for the client and just say you need to speak to another financial advisor who does that. Make contacts. There's a lot of you guys here today. Talk to each other, make contacts with each other, arrange some sort of referral arrangement. Number 5, research the products. If a client comes to see you, it's not enough for you to just say, okay, you've given me a superannuation statement, it has the details of your superannuation fund, and that's enough for me to go away and recommend something else to replace that. You need to show that you have made reasonable inquiries into the products that they currently hold and the products that you're recommending. We find a lot of advisors are not completing the RPAR, the Replacement Policy Advice Records, in the back of the SOAs. It's really important to do your research. You cannot compare apples to apples if you don't have that research. Okay. Number 6, base all judgments in advising the client on the circumstances in the client's relevant circumstances. That just basically talks about using all the other steps before to actually provide the client the best type of advice you can. Okay, this is the last one. This is a bit of a typo. It should be number 7 up there. This was left in because it is still in the legislation, but it's no longer in the regulatory guides, or in regulation, sorry. So it is no longer in your best interest checklist that I've left on your table. And we're sort of under the impression that that will be completely removed. This was the catch-all provision that basically said that the regulator or ASIC or FOSS or lawyers could look at any other circumstances, but this has now been removed. Okay. A couple of related obligations. So in the first couple of slides, I talked about 4 different points. I'm just going to go through them now. Appropriate advice. So what I tell advisors about best interest is, at that particular point in time, when the client came to see you, with the stuff that they had to give you, with the research that you completed, did you provide the best type of advice that you could at that particular point in time? And that's basically it. Okay, no one's asking you to see into the future, into things that may or may not happen. It's just at that point in time. So appropriate advice, I just want to draw your attention to the bottom part of this. So ASIC will look at if it is fit for the purpose. So it is if your advice satisfies the primary goals and objectives of the client, and the client is likely to be in a better position. And that differs. You might say, okay, well, if I put them in a better position and I save them $100 a year, that's really relevant to them. Okay, but then why? And that's an easy way to sort of see why. So you might have a client who is in a nursing home, and they might have basic life cover because they want to pay for their funeral expenses if they were to die, and maybe they've only been covered for $20,000 or whatever. $100 for them might be quite a good deal for them. It might be really important to them. They can't afford quite a lot of cover, and that's fine. You've justified it. You've made reasonable inquiries into their circumstances. You've identified their primary goals and objectives. You scoped out the advice. Great. But you might have a client who's young, who's single, who might have had $500,000 worth of life insurance. $100 for them is not really a big deal. It doesn't properly justify why you've recommended change in policies or change in insurance covers. Okay? Each circumstance is different. This is why I strongly recommend you drill down into why the clients come to see you in the first place. Appropriate advice again. So ASIC will look at a clearly defined scope of advice and whether you have helped the client set prioritized, specific and measurable goals. So back to your SOAs, please do not put in projections that are crazy and out there. 20% returns, it'll definitely cover you in the event of your whatever, whatever, whatever. Those things change. Those things may not actually happen. Okay? For life insurance, if you say you will definitely be covered in the event of something, make sure that you're correct. Make sure that that's actually covered. Incomplete or inadequate information. So I've talked about this a little bit before. We see a lot of complaints come through, and one of the things we've noticed is a client has really liquid memory. So what they remember happened today, for example, they will not remember it in 5 years' time. That's why it's really important to have your file notes and have your fact finds and have a good file. Okay? Just for your information, FOSS will definitely look at the file itself and they will ask you for feedback. So if you're missing anything, you are welcome to come and talk to them. They will ask you for things. But ASIC will just ask for your file. They will take your file and you will not get feedback for about 6 to 12 months. And they will not ask you for feedback either. So that's why it's really important to have good files and good file notes. If your processes are well, if you're comfortable in the advice that you've given, if you're comfortable in knowing that someone can take away that file and know exactly what's happening, that's great. Have faith in your processes. Have faith in what you're doing. We do have PI cover that will cover you. Prioritizing the client's needs. So this is actually putting the client's needs above everything else. For example, you might have an insurance company that you might be affiliated with somehow. Maybe if you write in a certain type of or a certain level of insurance, you might get some sort of benefit out of it. That's okay, but it's still really important to let the client know, and it's still really important to show why that particular insurance company that you're recommending is better than the others. Okay? Have quotes on file. Actually print it out and pop it in your file. Because again, 5 years from now, it'll be really difficult to replicate those quotes from 5 years ago. Have proper file notes, have good files. At the bottom, you'll see it says that it is not enough to just simply disclose that there is a conflict of interest. So that insurance company that I was talking about, insurance company A, if you do recommend them, and maybe you haven't done the research or you haven't sort of looked at other options, looked at 3 or 4 different other insurance companies, it's not enough to just say in your SOA anymore that you have an affiliation with them or you may get some sort of remuneration from them that's a little bit above. So leaving the client in a better position, so the ASIC will look at the position of the client would have been if they did not follow your advice, the facts at the time, and the subject matter and the scope of advice. So as I said before, at that particular point in time with the client, when they came to see you, the research you completed in their current documents, their current policies, their current superannuation, the research that you did on the products that you're recommending, the reasons behind why, that's what they'll look at. So here are a couple of examples on this slide in the dot points about how to leave a client in a better position that's not necessarily a monetary benefit. So you might, for example, improve their understanding in the financial position, align their financial position with their risk profile, increase their confidence in investing. Another example might be you might see a retiring client today. They might be in their 50s. You might do their risk profile. You might do their investments. And in that SOA, you might say, in 5 years' time, I recommend we look at doing a TTR, transition to retirement. That's not something that you might address today, because that's something you might address when they turn 55 or closer to 55. And that might be 4 or 5 years down the track. So that's an example of where you're providing strategic advice, but not necessarily product advice. And please, at the bottom, please complete the RPAR fully. Cannot stress this enough. It is really important. A lot of times we see things like not disclosed. Your job as the advisor is to actually find that information. Okay, I'm sorry, I can't really say this word properly, but what ASIC will look at is, in your situation, an advisor just like you with the same qualifications, same sort of background, provides the same sort of advice, is this what they would have done in this particular case? So that's what they'll look at. They'll look at your peers, they'll look at your colleagues, they'll look at other financial advisors, not just in Synchron, but across. So that's best interest. Please look at the checklist that I've given you. Please give it a go. Please try it. It's not compulsory yet for you to use it, but it is a really good step-by-step guide on how you can actually structure your files. I'll just also like to draw your attention to the court cases that I provided you. So these are the top 3 ones that have come out in the last couple of months. The first one, Macintosh versus Macintosh, that's sort of been brought up in a lot of SMSF cases. It's not actually an SMSF case, but it talks about estate planning and the importance of estate planning and having something like a proper binding nomination. The second one is really important. It's CFP versus Cooper. So in this particular case, the advisor was a CFP advisor, and he recommended that the client, Cooper, actually replace a Westpac product with a CommInsure product. The courts found that there was no 3-year innocent non-disclosure period disclaimer, or the client had no idea about it. There was insufficient information, so there was no proper research done at the time. So I understand, Commonwealth Financial Planning advisors are only able to use CommInsure products, and that was the third thing, inability to recommend a competitor's product. So please remember, we do not restrict you in the platforms that you can use and in the actual insurance companies that you can use. We just ask that the underlying products are on our APL. If you use a particular platform, that's perfectly okay, but still, it's really important to follow the steps I talked about before and to actually show why it is good for the client. In your SOAs and in your conversations with the client, please remember to bring up the advantages and the disadvantages. The last one, which is really important, is RAVSI versus National Australia Bank. So the client is Paul RAVSI and the advisor is Peter Moore. So Moore basically saw the client for a review, recommended that he reduce the amount of cover that he had. So let's say it was $500,000. He recommended that he reduced it to $200,000. Client went through the entire process, filled out the application forms, filled out the authority to proceed, received confirmation from the insurance company that everything was okay, everything was in place. He claimed a little while after, but then due to non-disclosure, because of the 3-year non-disclosure period, he was denied payment. For whatever reason, the client hadn't understood that he had actually had a reduced amount of cover. He had thought that he still had that $500,000 worth of life cover. In this particular case, the client had actually said that he wanted to reduce his cover, or he wanted it cheaper, or something like that. The courts found that financial advisors are experts in their field. Okay, and I just want to make this a little bit clear. If you're a risk advisor or a risk broker, you are not classified separately as a financial advisor under the law, under the regulatory guides. You are all the same. Financial advice covers everything. Risk advice, superannuation, investments, SMSFs, everything. So in this case, the court found that the advisor and financial advisors are experts in their field. You are experts, that's why clients have come to see you. If a client comes to see you and says, I want to reduce my amount of cover, you need to drill down on why, because that'll form your basis of advice. You need to actually notify the clients, at least verbally, or please in your SOAs, we do have space for that in your SOAs, the advantages and disadvantages of the products and your recommendations. Okay. All right, now I'm just going to cover a couple of other things that John has asked me to bring up, but also some legislative changes as well further down. Okay, so please remember we do have PI cover, but it only covers financial advice. If you provide advice, mortgages, let's say, property investments, real estate stuff, you won't be covered at all. It's happened before. Our PI guys have come back and said, we don't cover that, you are not covered for that, we won't cover you at all. And that means you don't have PI cover, and we have nothing that can back you up or nothing that can help you out. Okay. And this bottom part, really, really important, yeah? So authorised representatives are required to pay up to 75% of the excess of the policy to a maximum of $7,500 for financial planning advice. If you provide margin lending advice, and the case is in relation to margin lending, our excess is $50,000, of which 75% is payable by yourself as the advisor. Okay, pretty straightforward. TASA, Tax Agent Services Act. So TASA is not new. TASA has been around since 2009. The idea was to bring together everyone who provided any type of tax advice and create the Tax Practitioners Board, the TPB.